China's economy grew much weaker than expected in the second quarter as a lingering property crisis and job insecurity forced consumers to tighten their belts, a bleak picture for the world's second-largest economy that raised expectations that Beijing would have to roll out more stimulus measures. China's gross domestic product, GDP, grew 4.7% in the second quarter from a year earlier, the slowest pace since the first quarter of 2023 and below the 5.1% growth forecast by analysts in a Reuters poll, a sharp slowdown from the 5.3% growth in the first quarter of 2024. Data released by the National Bureau of Statistics showed on July 15. Overall, the disappointing GDP figures suggest the road to the full-year 5% growth target remains challenging, ING Bank chief economist Lin Song told Reuters, adding that the negative impact on household wealth from the slump in the property and stock markets and low wage growth amid cost-cutting by many industries is weighing on consumption. Households are now refraining from buying big-ticket items and focusing instead on basic needs like eating out, Song added. The latest GDP report comes as Beijing is expected to make fresh efforts to shore up confidence in the economy at the Communist Party's third plenum, which begins on Monday. Conflicting demands to boost growth while cutting debt make such plans harder to achieve. The Chinese government has set a growth target of around 5% for this year, a target that many economists consider ambitious and could require more stimulus on a monthly basis. China's GDP grew 0.7% in the second quarter from the first quarter, after growing 1.5% in the first quarter from the fourth quarter of 2023. To counter the negative impact of sluggish consumer demand and the real estate crisis, China has increased investment in infrastructure and high-tech manufacturing. However, these measures are considered insufficient to revive growth, according to the National Bureau of Statistics of China. Bad weather was a cause of the weak growth in the second quarter, while the economy faces increasing external uncertainties and domestic difficulties in the second half of this year. After the COVID-19 pandemic, China's economy has recovered unevenly, with strong industrial output growth but weak consumption. This situation has increased deflationary pressure in the economy amid a prolonged real estate crisis and local government's debt. Strong export growth has provided some momentum but comes with the threat of escalating trade tensions, reflecting these trends. Other data released by China's National Bureau of Statistics on July 15 showed factory output growth in June was stronger than expected despite slowing from May while retail sales missed forecasts. China's industrial output rose 5.3% in June from a year earlier after rising 5.6% in the month and compared with a forecast of a 5% increase by experts. In a Reuters survey, retail sales rose 2%, slowing sharply from a 3.7% increase in May and much lower than the forecast of a 3.3% increase. Data from China's General Administration of Customs last week showed that the country's exports rose 8.6% year-on-year but imports fell 2.3%. Statistics released last week also showed that the risk of deflation continued to haunt China. The country's Consumer Price Index, CPI, rose 0.2% in June from a year earlier, down from a 0.3% increase in May and the lowest increase in 3 months. The increase was also lower than the 0.4% increase forecast by economists. In a Reuters survey, the Producer Price Index, PPI, fell 0.8% in June from a year earlier, less than the 1.4% decline recorded in May and in line with economists' forecasts. In the Reuters survey, among the monthly figures released today, the weak retail data was the highlight. ANC Bank's Jishan strategy said that household consumption remained weak amid employers cutting wages and rising youth unemployment. Households will continue to be cautious with spending in the near term. China's property market situation even more bleak. New home prices in the country fell 4.5% in June from a year earlier, the sharpest decline in 9 years and the lowest since June 2015. New home prices in China fell 3.9% in May, while real estate investment fell 10.1% in the first half of this year from a year earlier. Home sales by floor area fell 19%. Last month, the governor of the People's Bank of China, Pan Gongshang, pledged to maintain a pro-growth monetary policy stance. Analysts expect the PBOC to cut the benchmark one-year loan prime rate by 0.1 percentage point and cut it by 0.25 percentage point. Reserve requirement ratio in the third quarter of this year, Citigroup Bank predicts the Chinese government will launch a new round of real estate stimulus measures after a Politburo meeting in late July. In May, the Chinese government asked local governments to buy up unsold homes on the market and the PBOC set up a 300 billion yuan, about $40 billion, fund to provide loans to convert acquired projects into social housing. Weak credit growth is another concern for Chinese policymakers, with PBOC data released Friday showing money supply growth and new credit growth slowed sharply in the first half of the year compared to the same period last year. of which, the amount of new loans granted to households in the first 6 months was 1.46 trillion yuan, equivalent to $200 billion, only about half of the $2.8 trillion in the same period in 2023. The amount of new loans granted to enterprises in the first 6 months was 11 trillion yuan, down slightly from 12.81 trillion yuan in the same period in 2023. Data on money supply and credit in June showed that credit demand was still weak. Recent policy communications show that the PBOC continues to focus on strengthening the transmission of the influence of monetary policy and reducing the importance of total credit growth. In the coming period, the growth of yuan loans and M2 money supply may continue to slow down, a report by Commerzbank commented. What do you think about the current economic situation in China? Leave your comments below the video. Country Garden was once the largest property developer in mainland China by revenue but is running out of money. A Hong Kong creditor has filed a lawsuit demanding that a property developer sell assets to repay debts, in a sign of lingering market stress. The latest development comes after the Hong Kong High Court ordered property developer China Evergreen Group to liquidate its assets in January. According to a statement from Country Garden to the Hong Kong Stock Exchange on February 28, the lawsuit was filed by Evercredit in the Hong Kong High Court, claiming unpaid debts and accrued interest of 1.6 billion Hong Kong dollars, $204 million. Country Garden said it would seek legal remedies to counter Evercredit's lawsuit. Evercredit's parent company, Kimbo Holding, a chemical manufacturer and property developer, did not respond to a request for comment. The Hong Kong High Court has set May 17 as the date for the first hearing of the case. A restructuring and insolvency partner at law firm Anus said the liquidation lawsuit against Country Garden could allow creditors to pressure the company to speed up the restructuring process and achieve better terms. While Country Garden is still negotiating a restructuring agreement with its international creditors, the company believes the lawsuit will not have a significant impact on its plans to restructure its foreign debt, although its Hong Kong-listed shares fell as much as 12.5% on February 28 to 63 cents. The developer drew global attention to China's troubled property sector when it missed a repayment deadline on several offshore bonds last summer, eventually defaulting in October. The default shows how developers once seen as having healthier financial metrics than rivals are still under pressure from an industry-wide cash crunch. The property downturn is one of the biggest challenges facing China's economy. New home prices in 70 major Chinese cities have fallen every month since October 2023. But Beijing has so far resisted a major stimulus package despite mounting pressure to act. The lawsuit against Country Garden is similar to one filed by Topside Global against Evergreen in 2022. Last month, Hong Kong's High Court ordered Evergreen to liquidate its assets to repay Topside Global after the property group failed to reach a deal on a restructuring plan. Evergreen, which had about $20 billion in foreign debt when it collapsed in 2021, initially proposed that foreign bondholders convert their existing bonds into new bonds with longer maturities or equity investments in Hong Kong-listed subsidiaries, a plan that failed after failing to gain regulatory approval. With total debt of around $200 billion compared to Evergreen's $340 billion, Country Garden is a key part of China's real estate sector, which typically accounts for more than 25% of overall economic activity. The filing of the lawsuit against Country Garden is not surprising to us, Jens Eist, financial analyst, told the BBC. However, he said that Country Garden would be unlikely to avoid a court order to liquidate its assets like Evergreen. Please remember to subscribe and hit the notification bell to stay updated with all the latest information. Thank you and goodbye. Until next time.